Two people. Same age. Same job. Same $300 a month. One waits for the crash to buy. One doesn't think about it at all. 40 years later, one of them gets quietly demolished. It's the one trying hardest to win. And here's the part you won't believe. Researchers tested a perfect investor. All-knowing. Buys the exact bottom of every crash. Even that investor lost. How is that possible? That answer is waiting at the end. Call them Cole and Carol. Same starting point. Same $0. One belief is different. Carol thinks the market is a slow, ugly escalator. Keep stepping on. No matter the floor. Cole thinks the escalator collapses. Keep your money dry. Wait for the fire sale. On paper, Cole sounds smarter. Buy low. The first rule of investing. Carol's plan sounds like not trying. She buys high. She buys low. She buys on terrible days. On purpose. One is using a brain. The other, an automatic bank transfer. Hold that. At first, Cole looks like a genius in waiting. The market grinds upward. Carol's $300 goes in monthly. She isn't thinking about it. That turns out to be the entire point. Cole is watching. He has a watch list. Every new high makes him more certain. The fall is coming. He tells friends he's waiting for a better entry. Time passes. The crash doesn't come. From March 2009 to February 2020. The market climbed 11 straight years. No bear market. Around 400% returned. Picture Cole sitting through all of it. Cash and savings. Refreshing his list. Muttering it can't keep going. Every month, Carol's gains compound on last month's gains. Every month, Cole is patient. A respectable word for doing nothing. Here's a stat that should make you uncomfortable. Since 1950, the market closed at a record high on 7% of all trading days. A third of those highs became permanent floors. Never dropped below again. Wait for a dip usually means wait for a price you'll never see again. The market is positive 3 out of every 4 years. Cole isn't betting on a coin flip. He's betting against a loaded coin. Over and over. With his future as the stake. Real bear markets come every 3.5 years. Roughly. Only 1 in 4 corrections becomes one. Cole isn't waiting for a late bus. He's waiting for a bus that might not come for a decade. But maybe you're thinking. When the crash finally comes, Cole pounces. Makes it all back in one heroic move. Reasonable. Let's test it. Charles Schwab ran the study. 20 years of market history. 3 investors matter. Investor 1, perfect timing. Bought the exact lowest point. Every single year. For 2 decades. Investor 2, fed money unevenly. No thinking. Basically Carol. Investor 3, kept cash. Waited for the right moment. Exactly Cole. The perfect timer finished with $186,000. Carol's approach, $166,000. 20 years of literally perfect timing. Beat autopilot by $20,000. Total. $1,000 a year. Now the cash waiter. $47,000. Not a typo. A quarter of what autopilot made. And the kick in the teeth. Schwab tested one more investor. The unluckiest possible. Bought the exact peak. The worst day. Every single year. That cosmic disaster still tripled the cash waiter. Buying at the worst moment, on purpose, beat waiting for the perfect one by a factor of 3. Being in the market on terrible days was a rounding error. Not being in it at all was the catastrophe. Stretch it across a century. $100 into the market in 1928. Over $1 million today. The same $100 in cash. About $2,500. One is generational wealth. The other barely covers dinner. Every year Cole waits, he chooses the dinner. There's real investor data on how people actually behave. In a year the market returned 25%. The average investor earned 16%. They pulled money out in every quarter. Biggest withdrawals right before the market ripped higher. Cole's plan requires him to be calm and aggressive. At the exact moment humans are terrified and selling. A crash isn't a green light. It's a wall of red headlines. A retirement account down 40%. Someone asking if you should get out before zero. Buy the dip demands the most courage at the moment you have the least. Carol never needs courage. She's already buying. Through the bottom. On the way down. On the way back up. Her $300 bought more shares automatically. She turned the scariest moments into her best purchases. Without feeling a thing. Because she removed herself from the decision. Now. The answer I promised at the start. How does even a god lose? One researcher built the perfect dip buyer. All-knowing. Deploys cash only at the exact bottom between any two highs. Perfect knowledge of the future. Tested against boring monthly investing. Across every 40-year stretch since 1920. The boring investor beat the all-knowing god more than 70% of the time. Why? Because while God's cash sat waiting for the perfect bottom, it earned nothing. And the market drifted upward the whole time. The bottoms he waited for sat at prices higher than what he could have paid years earlier. Perfect timing lost to no timing. Because the waiting itself was the cost. And it gets worse. Make the god slightly human. Miss the exact bottom by just 2 months. The dip strategy loses 97% of the time. Real humans aren't off by 2 months. They're off by a country mile. Usually the wrong direction. That's the payoff. The edge was never in timing the market. The edge was in never needing to. The next time someone says they're waiting for a better entry point, ask one question. How long are you willing to wait? The market doesn't owe you a crash. And while you wait for the perfect moment, the only thing compounding is the cost of waiting for it. If this changed how you think about the cash in your account, subscribe.